up. Hey, Celia, you and me got the comfy cash memo today? I had all the intentions of having makeup on and having my life together, but then I had appointments and my house full with people, so that didn't happen. So you get me natural. Let's see, making you the co-host, Mariana. Did it work? Let me know.
Yeah, it worked.
Awesome. Okay. I'm gonna start feeding this baby over live before I forget it. Mariana, what did you do? Because it is actually very nice and it types in the title of the meeting and the description of the meeting automatically when I feed it over. That never happened before. So whatever you did.
I have no idea. I didn't do anything actually.
Okay, well, maybe Zoom finally talks to the calendar. That is nice.
Maybe that would be awesome.
Okay, hi everyone. You're here early. That's wonderful. Mariana, did you post a reminder in the group that today's is a different link?
Yeah, I should have gone through. I haven't had a schedule. Let me check.
Okay. Takes a village, guys. Joanne, you working from your mobile office today? Yes, yeah, it looks like you're in the car. Autumn, how you doing? Rock star.
Good.
Wasn't that a simple change?
100%.
Autumn and I had a coaching call a week ago, right? Or something like that.
Yeah.
And she just had a simple question and I looked at her accounts. I was like, well, and next thing you know, she implemented everything I said. And you got how many listings?
3.
That's amazing. You're a rock star. I love it. Love it. Good job, girl. But I guess the moral of the story is that you implement, right? I mean, you literally, I had that day when we had our coaching call, I had a house full of people, agents from Arizona. And one of them saw it on your page and she's like, oh my gosh, she's already did everything that you said, Gogo. And I didn't even get a chance to see it, but I'm so excited to hear that you implemented and you see the results.
Hey, Gogo, just FYI, our guest is already here.
Oh, Toby, you here? Let's see.
Oh yeah, I'm hanging out.
Oh, hey, Toby, how are you?
I'm doing well. How about yourself?
Do I see your name? I don't see it on the screen. Oh, there you are. Okay, I see you. Awesome. So if you don't mind, just hang with us. We came early because once a month we open this up to the public. So it's a little bit more complicated than our regular meetings. But we already fed over to our Facebook group, our private Facebook group as well. And we upped our head count. So we should be able to host everybody here. And we usually start with the mortgage minutes. So right on the hour, we're going to start with Randy and it is right on the hour and he's traveling right now. So Randy, are you almost good to go?
Oh, I'm good to go right now, guys.
Okay. So if you don't mind, then we get started with you. So everyone, this is our weekly Team Gogo production training. So every Wednesday we get together and we talk about anything that is going to make us more money, sell more real estate, and today's case, keep us more money, which is so exciting because I remember when I initially hired a CPA and then he started asking me all of these questions. I was like, I have no idea what he's talking about. He's like, do you have an S Corp? How about a C Corp? Do you have an LS? Like, I was like, oh my gosh, bring it down to my level. So we are going to have Toby. He's our Toby Mathis. He's our main speaker tonight, but we usually start out with Randy and the mortgage minutes. So Randy, can you tell us what's going on the mortgage market?
Yep. Regarding the mortgage market, today you're going to see we don't know what's going to happen now, but the Fed's going to come out and they're going to basically make an announcement. They're either going to say that we are going to keep interest rates a little bit low. They're not going to be as optimistic as they were last time, or they're going to say, guys, we have more quantitative easing to do. So today's going to actually be a big day for the next 30 days on how mortgage pricing is going to pan out. So today you can actually see after the Fed meeting, rates go slightly down or slightly up. So it's actually a very, very important meeting today that we need to stay on top of, because remember what I said last week, interest rates have been going up steadily over the past 45 days. Whereas you were getting a 30-year loan at 2.9% 45 days ago, today you're seeing 4, 4.125%, 4.5% in some cases at other institutions. The cool thing is we have cool products that allow you to avoid some of these higher rates. So although the rates have gone up, there's certain disparities that we've noticed and we're capitalizing on. For example, now you need to know different kind of programs. And one of those programs that you used to see very prevalent back in the early 2000s and around the 2007, 2008, 2010 range, you're going to see more combination first and second mortgage products. So what that means is you're going to see people getting an 80% first mortgage followed by a 10 or 15% second mortgage. So that was very prevalent years ago. You're going to start to see that make a comeback now. Other things you're going to start to see are more portfolio products coming out. You're going to start seeing the banks coming out with different products. For example, one of the products that got released recently was a 25% down stated primary home purchase. If that person has been in business for 2 years but didn't show any taxes, you can actually go back to stating their income, which is actually, it's crazy if you think about it. So again, if they have 25% down, they're not just regulated to a hard money loan. They can get a 5 to 6% primary loan with 25% down, stating their income. So if they showed $2,000,
this would be a great question for Toby. So let me get this straight. I can skip paying my taxes for 2 years, and then 2 years later, I can buy a house stating that I did make $200,000 while I forgot to kind of claim it for the last 2 years.
So do you want me to answer that or Toby?
We'll ask Toby later. But it does sound like, you know what I mean. This is a sake of the joke, but I'm sure there is a loophole right there somewhere.
It is, but a lot of people starting their business, especially during COVID times, it was very hard for them to start showing income because the business didn't do as well. But normally the rule is if you've been in business for less than 5 years, you have to show 2 years of continuous income. The problem with that is you have to take a 2-year average. So let's say you opened in COVID and you only did $15,000 in total net income, but then the following year you did 150, you no longer have to take the average anymore. The cool thing about this product is, although it is a high down payment, 25% down, essentially, though, look what it allows. If you know you have this product in your arsenal, a lot of people don't like to pay taxes. So they didn't pay taxes. Is
there anybody that likes to pay them?
Well, certain people, when you get to a certain level, like you want to pay taxes for different reasons. You want to open more businesses or you want to show sustainability. Well, in this case, they saved all that money and not paid taxes. So they have the 25% down payment because they didn't pay their taxes for 2 years. So they have that money set aside in an account. It's really an incredible product. Now, are there inherent risks? Yeah, but the inherent risk is to the lender because the rate is marginally higher. It's not that much higher. There's no extra closing costs essentially with this product. So it's a good product. But there's other products coming out. For example, I think I told you guys about this last week. 5% down jumbo. Guys, you can buy a home up to $1 million, only put 5% down. Not a lot of banks in the United States have that program. We do have it in about 8 states right now. So that's a really good program. You go buy a home for up to $1 million, you put 5% down. Normally, you can only do that product up to the conventional limit, which is 647. In this case, you can go up to $1 million. So that opens you up to a whole bunch of buyers. I just want you guys all to know that. That's a very, very, very solid product. Another thing that we're starting to see is you're going to see more banks, offer incentives and, like I said, different portfolio products. But one product that we have for the next 2 months that's going to be a great product for everyone, just released today, is we're actually going to credit the buyer their appraisal on all transactions done through March 31st. So if they get an appraisal, we'll credit up to $600 back for that appraisal back. So that's something that you can go out there and sell. Hey, we have a lender that'll pick up the cost of the appraisal. That's a big thing. And if you're in the state that we're in, I can hook you up with another mortgage company, a broker, one of our partners that's in the various states. So always feel free to reach out to me regarding that. But today, what to watch, the news to watch today, are rates going to go up? Are they going to go down? In my opinion, There's too much happening in the market, too much happening across the world. And when this happens, and there's inflation concerns, and we're in the super bubble concern, I don't see the Fed being hawkish on at all raising interest rates or leaving a negative sentiment. So I think rates are safe for now, but at the same time, still watch that. Lastly, the 30-year rate right now is hovering right around 3.875 to 4.25, 30-year fix. But get this, we have a product, and again, we can reach out to other banks and see if they'll allow you to work with them on this product. This is a time where I say, you know what, take advantage of this product. It's a 10-year adjustable rate mortgage. It's fixed for 10 years. Now keep something in mind. The average American sells or refinances their home every 7 years. This product fixes their loan. So if the rate today is 4.25, well, we can offer them a 3.25 interest rate, 3.25, 10-year fixed, 30-year amortization. It saves on point. Just again, going back to the math, I don't have my calculator. I'm at the airport, but just to give you an idea, if they have a $500,000 loan and you save them 1%, guys, you're saving them $250 a month. And if you tell them it's fixed for 10 years, and when people hear ARM, they get kind of uneasy. But if it's fixed for 10 years and they know the average American refinances or sells their property every 7 years, it's still a great product to sell because it allows them to have a lower payment for that long-term period. $250 a month over a 5-year period comes out to $3,000 a year, $15,000 over a 5-year period. That's some huge savings there. So that's all I really have for today. Hope you guys enjoyed that part. Do you have any questions at all?
Thank you so much. The best way to get a hold of Randy, guys, he has a button on the Team Google website. So you can just go in our website, click the button, and you can get a hold of him and his team if you decide that you want to work with him. Thank you, Randy. Thank
you so much, guys.
Thank you. Thank you. So a little bit about our next guest. I'm so excited that he's here. It's kind of a big deal because he's one of the best tax attorneys in the country. So for him, given an hour, I am like beyond ecstatic. So thank you, Toby, for being here. Let me tell you about Andersons and how this happened. I've been in search for, let's just put it this way, that I feel like I personally have grown faster, that my cute little brain can understand a lot of things, right? And so then you get advised by a financial advisor, and then you get advised by your CPA, and then you get advised by your friends, and then you get advised by your attorney, and your financial advisor says, what a great idea. And your CPA say, don't do it. And then your attorney says, what the heck, don't you dare sign that, right? And then you're in the middle, supposed to have to make a decision about something you don't know anything about. So what I wanted to do, is to have a board of directors that literally are by my side. They understand not only where I'm at, but also where we're going, because some of the decisions that you have to make, especially when you create your board of directors, right? To most people make the same amount of money with maybe a couple percentage plus minus every single year. So when they make a decision this year, what they need to decide about their taxable income and yada, yada, you might have to take in consideration where we are heading next year, right? So I wanted to have a board of directors and happened to have Christine Frusion from California, who's one of our business partners here from California, with her husband, Carl. And I was telling them about what I need, and Carl just showed me this dashboard that he has. Where's this light shining on my face? Can somebody find it? Sorry, I don't know. I don't know where it's coming from, but it's right in my eye. Oh, there we go. Problem solved. Thank you. If you could just stand there, that would be wonderful. The sun shining. Thank you. So Christine Frusion and her husband, Carl, were in town, and they showed me their dashboard. And I was like, whoa, like they literally had, I'm very visual. I don't know how your brain works, but I need to, in order to understand of like which LLC own which company, and if there's a holding company, it's like where do they feed, and which one is an S Corp, and which one has a manager, and which one doesn't, which Toby's going to talk about that today. I needed to see it. So after I saw their dashboard and realized that they have everything in one place, they have all of their LLCs in one place, and they have all of the operation agreements, and you have an attorney, and you have an asset planner, and you have a bookkeeper, and you have a CPA, and they're all on your team to represent your best interest. I was like, please sign me up. So I was so excited to interview them. And after I got access to everything, I was like, this is it. So I've been an Andersons customer now, probably 3-4 months-ish. I have loved it. Now, don't get me wrong, it is work on your end to get all your ducks in a row and all your documents uploaded and all that. We are nowhere near completion, but just being in the process of all of this, I'm very, very excited on my end. I reached out to Toby and asked if he would give us his time. He is a tax attorney. And I explained who we are and what we do for a living. So I asked if he would do a presentation for us of what we need to know as realtors because it's one thing to make money, right? And it's another thing how much of that you actually keep and take home. So the idea of today's presentation is just that, is to make sure that you're structured properly, that you have protection, right? And you have your liabilities in order, and then you make the most amount of money and you get to actually keep most of it and not give it to Uncle Sam. So Toby, thank you so much for being here.
Oh, thanks for having me. It looks like a fun group.
We are quite fun over here. So can you tell us a little bit about you and like why on earth did you even get into being a tax attorney? It sounds
Yeah.
fun.
So yeah, I became a tax attorney. I think it's been 25 years and I've been trying to make amends ever since. No, I didn't start off in tax. I started off just general practice. And when I first opened up, like I never worked for another firm. I came right out of school. I never intended to be a traditional lawyer. I was a business person in Seattle and just didn't like my interaction with attorneys because they tend to be downers and they're really expensive. But I ran into a CPA who made me feel really stupid. And my first meeting was eye-opening about how they used big words and made you feel dumb and like I shouldn't even be in business. And I just kind of swore at that point I would learn taxes and make it understandable because I felt like they were not doing a service to me or anybody for that matter. They were just not the nicest folks. And that's not a condemnation on CPAs. I just think that it's a different, I have a ton of them that work for me. It's just.
Yeah, they just speak a different language. And I feel like real estate, when we get into it, even just the real estate terms and the actual, like, I feel like what we actually learn in school, and then when they throw you into the deep water to start swimming and showing houses and writing contracts, like we never even learn how to write a contract. Never. Nobody ever teaches you that, right? Unless you're like, I remember showing my first house and they were like, okay, we love it. Let's make an offer. And I was like, what a great idea. But how do I do that? And then take it one step further, right? And now suddenly you have a CPA and a bookkeeper and they speak their lingo that I never learned. Right. So I always tell, I have an amazing CPA now. And that's, one of the questions that I had when I joined you guys, can I keep him? But you guys look over my taxes and make sure that we didn't miss anything. Right. So then I have multiple eyeballs on my taxes. But with this CPA, when I hired him, it was important to me. And I usually catch him or I snap him right in the middle. I say, hold on a minute. You're talking CPA lingo. I need you to bring it down to my broken English level. So I understand what we're actually talking about.
K through 12 is what we call it, making sure it's actually understandable. And more importantly, that you can use it. Like I could talk all day long about code provisions that just make me sound smart, that mean nothing to you. It's not applicable, yay, I get the cocktail party smartness, but at the end of the day, you have to be able to implement it and it has to save you money and put dollars in your pocket. And realistically, there's some very easy ways for realtors, specifically as a group, to make a lot more money. It ends up being about 10% net on an annual basis is about the average, simply by structuring your business correctly. And I know I'm going to hit that today, and then I'm going to plant one seed to you guys of creating a legacy. And this sounds kind of foreign for people to hear this, but I would suggest that you think what you want to leave and think of it in 200 and 300 years. Like, what do you want to be known for? What kind of values do you want to leave, whether it be to your kids or to organizations that you care about? And they go hand in hand, believe it or not. It's kind of like time value of money. One of the best investors of all time, Warren Buffett, he didn't become a billionaire until his 50s. Now he's worth almost $90 billion. It's because he keeps living. If he had passed away at 50, you wouldn't be hearing about the guy, right? But the longer he goes on, the bigger it gets. And that's how money works, is if you put some of these things in play now, and especially if you do it in a tax advantaged way, when you retire, or if you choose to retire, you're going to have a boatload of money sitting there if you give it time. What will kill it is if you watch this, these cable TV shows and these traders and all this stuff and it makes you do stuff. Wall Street makes its money on activity, and you make your money on inactivity when it comes to taxes and savings. So you just want to put something in place that, whether you think about it or not, is generating you capital. And one of the easiest things to put in place is a tax plan. So that's what I'm going to hit today. If you're good with it, Gogo, I can start knocking it out.
That sounds fantastic.
See there.
And
Oh,
we all just sound so excited about a tax plan. Yes.
Hey, okay. Well, here's the deal. Extra
Nobody said
money in your
it.
pocket, but you're going to have to make me a co-host or something so I can
Yeah.
share my screen.
You should be able to do it now.
Yay. There it is. All right. So guys, number one, I read the chat. If you're able to do chat, if you're not, I read the Q&As and everything while I'm talking. So don't even worry about, like, if you're able to chat, feel free to ask me questions as we go. I'm not one of those guys that says, here's my presentation, I'll take the questions at the end. No, I want you to understand it and be able to use it. So, so that said, I'm used to flying off the cuff and answering questions. And there's no question that's out of bounds. Like, ask me anything as long as it's pertaining to what we're talking about, it's for clarity. I'm going to show you a screen here. And these are the different types of tax treatments for real estate. Just a small little sampling of everybody from a real estate agent to a wholesaler. If you don't know what that is, that's somebody that's getting a finder's fee for finding properties or doing double closes. I have a ton of wholesalers. It's not illegal except in Illinois, but it's alive and well. We wholesale off about 100 properties a month, myself and my group. I own, me personally, with my partner, north of 300 properties, including office buildings, warehouses, single families all over the place. So I know what I'm talking about when it comes to real estate. And there's totally different tax treatments on these things, whether you're in residential, investment property, if you're a flipper, if somebody's Airbnb, that's not even rental. If it's 7 days or less, it's an ordinary business. So like, there's so many little nuances to know. And the fact of the matter is, nobody really knows it all. So just know that when you have somebody on your team that is able to answer these things, it becomes a huge asset for when you do come across it. It's just to be able to say, hey, you know what, there may be an issue there. And I'll give you an example. Gogo, do you guys sell properties that sometimes are that have appreciated more than $500,000?
Well, I would say no, not in Pinckney, Michigan, but because we are all over the country, that's a definite possibility. And with our agents in California and Florida and all of those like coastal.
So a lot of agents are used to that. It's called a 121 exclusion, but it's the $250,000 or $500,000 capital gain exclusion. They don't understand necessarily how it relates to depreciation recapture if a portion of the building's been used as a home office and things like that. Sometimes that trips people up. All I'm going to point out is that 121 exclusion is one thing that you have to avoid tax. You can actually couple a 121 exclusion with a 1031, which is a fancy way of saying you can avoid all the tax on any property, whether the person who's selling it has $1 million a gain, $2 million a gain. If you want to avoid the tax on the sale, you can. There might be a step you have to take, but you absolutely can. And just letting a realtor know that, saying, hey, by the way, hey, you have a $2 million listing or a $1.5 million listing, and they've owned it for a while. You may say, hey, we have a tax, we have the ability to get these questions answered on our team, just to make sure that you're saving it. And so somebody has asked, is the advice specifically to Michigan? No, this goes nationwide. And the tax advice I'm going to give you is federal, but does apply to almost every state, but depending on your state and your realtor rules, we may be looking at an S Corp or an LLC taxed as an S Corp for the business structure for a realtor. Almost never do you act as a sole proprietor, although the vast majority of real estate agents structure themselves as sole proprietor. That's the worst thing you could do from a tax standpoint. You're paying considerably more in taxes. It's going to save you about 10 to 15% of your net just to make a tax election. And I'll show you why.
Let's talk about that a little bit. So initially, when I got my LLC pretty much right away after I got licensed, maybe a year or so after. But initially, when I got it, my CPA at the time said that I shouldn't have an S Corp because it doesn't make financial sense. So it wasn't an S Corp until a few years later. So you see what I'm talking about? A CPA is going to tell you one thing, and then an attorney is going to tell you another thing for two different reasons, right? I'm assuming the CPA told me not to do that because of financial reasons. You're telling me because of legality reasons, correct?
Usually what they're doing is they're projecting their lack of understanding onto you. And so I could show you the numbers. In fact, I have these things handy. So let me show you.
Perfect.
Dollars and cents wise, this is a $60,000 person. And I could tell you the numbers if you were making 25,000. Here's the side-by-side comparison. If you made $60,000 as a sole proprietor, which is, here, I'll highlight it for you so you can see it. This is sole proprietor. This is S Corp. This is without even taking advantage of all the S corporation tax benefits by having you as an employee, which is something called an accountable plan, which will save you even more. But without even considering that, the difference between these is a little over $4,000. I'll actually highlight it and make it a little bit bigger so you can see it even closer.
So can we break it? Does everybody else, do you guys understand what he's talking about? Do you want me to dumb it down a little more? Because I think we should.
Okay.
I think there's three kinds of realtors, Toby. There's the realtors that are doing everything under their license and they do not have an LLC. Then there are those realtors that, decide to do an LLC. Yeah, Kat said dumb it down a little bit. So then there are those realtors that decide to open an LLC, but they are still not an S Corp, meaning they do not draw salary, right? Everything that comes into that LLC is technically income. And then you have the option of an S Corp, and then you have an option of a C Corp, correct?
Well, depending on your licensing board.
Yeah.
Sometimes they will not allow you to be a C Corp. They'll make it have to be an S Corp.
Yeah, so let's start with the basic. Let's start, then I don't have an LLC and I'm just running business under my license and I made $60,000. What would that look like on this screen?
That would look like this Schedule C. That would look like this.
Got it. Okay.
I'm doing nothing else, but I'm doing a Schedule C. And this is because it's easy and it mixes your business and your personal together. The reason that I don't like this is because if you make a mistake, and I'll give you a great example. We sold a property in Baltimore. The realtor is getting torn apart because of termites. They're suing them for fraud. There was a disclosure, there was a termite inspection and everything else, but that does not mean that the lawyer doesn't get a hold of you and shake you like a rag doll. That realtor is having to pay that out of pocket. There's no way to get rid of it.
Wouldn't an E&O cover us?
The E&O is not going to cover a fraud.
Oh, yeah.
So
Yeah.
in their
But
particular
if it's
case,
proven, yeah, if it's proven.
right. So lawyers know that. So when I sue somebody, I can choose what I sue you for. So I could say, yeah, there's breach of contract. Hey, that there was a fraudulent misrepresentation. There was intentional acts. And, there's all these things that I think that this agent did. But if I want just insurance, I sue you just on negligence, right? I'm going to look at the E&O policy and I'm going to see what it covers and I'm going to sue you for that. So I know I get the premiums. If I want to get to your personal assets, like I see you own a home and I see that you have some other nice things, maybe you have a rental property, I'm going to sue you for things that the insurance doesn't cover. Because even if the insurance provides you as a lawyer, they're going to do so under reservation of rights and say, you have to pay out of your pocket. We have the right to come back after you for contribution if we settle. And if you don't agree to settle, you're on your own. Like they'll just say, here's the portion that we believe we're responsible for and walk away. You are on the hook for that and you can never get rid of it. You can't bankrupt fraud. You can't bankrupt intentional misrepresentations. Lawyers know this. Like if I get that, it's following you until you're dead. I want to have an entity around that. I want to use an LLC or a corporation to say I'm acting on behalf of the company. Worst case scenario, I shut down the company and they get nothing. What that does is it forces lawyers to sue you under the policy only. And what you see is you're probably never going to get sued because they don't have a deep pocket to chase after. Or if you do, it's going to be for it's just going to be for a peppercorn. It's going to be for the frivolous value of it. That's why you set up an LLC or an S Corp. Now, I want to make sure that there's clarity here. LLCs exist in a state. They do not exist to the IRS. So an LLC is not a type of tax treatment. You can have an LLC and say, I want to treat it for tax purposes as an S Corp. So when you hear agents say, I'm either going to be an LLC or an S Corp, you can have an LLC taxed as an S Corp, or you could have just a standard S Corp. It really depends on your licensing body as to whether they have a preference and whether there's a restriction. Most don't. They're like, hey, you can be an entity so long as we can see who the owner is. And the reason that the licensing boards want you to be the S Corp is because you're disclosing who owns the S Corp on your tax. Like, so they can see that it's not some unlicensed agents that's a partner with you. They can see who the owners are.
So what is the main difference between being, besides now we got the difference between just being an agent and having an LLC, but what are the main difference between having an LLC and filing as an S Corp or being an S Corp?
That's the beautiful thing. And I have the question, by the way, Nikki asked, what are the costs involved when you do an S Corp, payroll tax, et cetera? It ends up being about, I would say, $1,000 a year, potentially an additional cost. If you're doing payroll, it can be done like we do payroll here. It might be, I want to say $199, but I want to show you something to demystify it. Here's two tax returns. I'm going to call them 1 and 2. Which one looks more complicated, 1 or 2?
They're the same.
They're the same. This is a Schedule C. This is a sole proprietor.
What
This
does
is an
sole
S
proprietor
Corp.
mean?
What's that?
What does sole proprietor mean? I can't even say the word.
The individual is running their business as themselves. So it's on your 1040 on your
It's a regular
personal tax.
LLC.
What's that?
So it's a regular LLC.
It can be an LLC disregarded to you as an individual. So a lot of accountants will say, you're going to be a sole proprietor. We're going to file it on your tax return.
Yeah.
And I'll show you why you don't do that when I actually show the numbers.
Is that the same
But
as the
the difference between these, does that mean no LLC? No, it means LLC taxed as an S Corp. We want everything to go as an S Corp if you're a real estate agent. If you do everything under your personal name, you're going as a sole proprietor. If you set up an LLC and say ignore it for tax purposes, it's called a disregarded LLC, then you're doing it as a sole proprietor. If you do a DBA under your personal name, you're a sole proprietor. And it's the easiest way to do it. Now, here's the reality. The record keeping requirements are identical. Books and records by the IRS does not distinguish between a sole proprietor, S Corp, C Corp, partnership, trust. It does not matter to them. They do not care. So not only do they ignore the LLC and they say, tell us whether it's you or an S Corp, and the record keeping requirements are the same. So it never makes sense to me that, you know, accountants say, well, it's so much easier to be an S Corp. What they're saying is they're not keeping it in compliance. So it's not going to win if you get into tax court. Somebody says, can't you do an LLC taxed as an S Corp? Yes, Chelsea. An LLC is something that we set up with the state, and the federal government says, how do you want me to tax it? And you could say, well, I want you to ignore it. I want you to treat it as a C Corp. I want you to treat it as an S Corp. I want you to treat it as a partnership. They're really easy. LLCs are fantastic. And if you can set up an LLC and be taxed as a S Corp, that's usually the route we go. Usually the route. Should I change? What's the difference? I'd have to see exactly what you're asking there, Valerie. But let me just show you the difference from a dollars and cents standpoint. S Corp versus partnership, or excuse me, versus sole proprietor. If I just set these things up and all I do is file that one page to make my LLC an S Corp versus having it just be taxed on my personal return. What happens is you save on all of the profit that comes out of that business. and I'll touch on that in a second. You do not have to pay Social Security taxes. Social Security taxes are 15.3%. They're also called self-employment taxes. So it saves you what amounts to about, the math ends up being 14.1%, but a lot of people say 15.3. There's a partial deduction. You save 14% on the money that you take. The only thing that we have to do differently is we have to take a small salary. So if you set up an S Corp, you would take salary once a year, once a quarter. If you want to take it monthly, you can, but it's a portion of the total profit. That's why accountants say they're harder, is you do have to do a payroll, but you could do payroll once a year. And you could just say, hey, I made 100,000. I'll take $30,000 in payroll. But that's not a bad thing. You could defer 19,500 of that directly into a 401k if you want and pay no tax on it. It's actually very, very easy, but I'll just show you kind of the math. I am getting an extra $4,600 off of making 60 grand. So just put it in perspective. I am going to keep an extra close to 5 grand just by making an S election. All I have to do is one payroll. So if I told you, hey, you have to do one payroll, but I'm going to give you a check for 4 grand every year, would you do it? That's the question. And it gives you the protection. If I'm making more,
and your CPA also does that. So it's not like you're going to have to suddenly do payroll. Like
It's
most CPAs will give you a service and they say, hey, you can reach out to this company, or they might even do it for you.
yep. And like, there's lots of places. I don't know if you have employees, like if you're an agent that's just you, it's really easy. If you're an agent and you have employees already that you're doing W-2 for, then it's just adding yourself to it. It's super simple. Like it'll take you, maybe a few minutes. It's not going to take much at all. If it's just you and you have to do payroll once a year, that's going to be the hardest thing. We do it for our clients. I think it's $199 to do them quarterly. It's not that much. But your accountant may do it for you. You could go to, Payroll City online and do it, or Intuit online, do it. There's lots of easy ways to do it if you want to do it yourself. If you're making 100 grand, by the way, here's the numbers on that. You're going to save yourself over $7,600. And this is just one little aspect of it. There's other benefits to being an S Corp because you become an employee. And I'll show you those in a second.
I don't see the writing on the left. So the 14,000 or the 22,000, that's the amount of taxes you would have to pay in, correct?
Correct.
So if you made
right.
100,000, you took your expenses, yada, yada, you would have to pay in on a Schedule C, which means you're not an employee you don't have an S Corp. So guys, and correct me if I'm wrong, Toby, the way I understand it, you can have an LLC. If you're not an employee of that LLC, that means you don't have an S Corp. S Corp means you draw a salary. You don't have to draw that salary monthly. You can draw it in the end of the year. And that's what I usually do because my income changes so much per year. And you have to be reasonable, right? So I can't make $3 million and draw a $30,000 salary because then the government's going to say, yeah, I don't like that, right? So because I don't know how much money I'm going to make, we do that at the end of the year. I'll draw a salary at the end of the year. So that makes you fall under S Corp. So if you are an employee of your own company, you are an S Corp. Why you're an S Corp? If you look at this in the bottom, that just means that you get to write off more things and keep more of your money and keep it at home.
This is just the self-employment tax. This is without even the additional deductions, which I'll show you are actually pretty massive. But what you said is spot on. You can't actually be an employee of your own sole proprietorship. You can't take payroll from your own sole proprietorship. It has to be a corporate entity. You can't do it as a partnership. It has to be a corporate entity. It has to be an S Corp or a C Corp or an LLC taxed as an S Corp or taxed as a C Corp. So if you're a realtor.
I think what's confusing to me is the letter C right there, because Schedule C and a C Corp is something totally different, right?
Oh, trust me, we've seen people, you absolutely beat your head against a wall. I always just say, use the, in our terms, we always say, is an 1120, an 1120S, is it a 990, is it a 1040?
Okay, guys, you see what I'm talking about? He's
Mm.
speaking code language.
Yep.
Schedule C, let me dumb it down to us realtors that have no training in nothing ever, really, right? We just kind of winging it every day. Schedule C means you don't even have an LLC. You're filing all of your taxes under your own social security number, just you as a human, right? You can do it jointly with your husband or whatever, but you don't have an LLC. S Corp, you can have an LLC without having an S Corp. So think of it as so you could have an LLC and still file as a Schedule C.
Yep. LLC go like this. The IRS doesn't see it.
Yeah, doesn't exist in the state eyes, or sorry, in the federal eyes. It
To
doesn't.
the IRS, they don't recognize an LLC. They say, how is it taxed? Just tell us. And you could pick.
Yeah.
I could be a trust, I could be ignored, I could be a partnership, I could be an S Corp, I could be a C Corp. Technically, I could even be a nonprofit.
So now think of it this way. If you start making a lot of money, right? If you stay as a Schedule C or just as an LLC, everything that company is going to be making, it is your income, correct? You're going to be paying taxes on it. That is your income.
Yeah,
Now,
I'll
if you
make this. If
Yeah.
you are not filing a tax return for your business, it's just going onto your personal tax return. It's going onto your 1040. There's no difference between you and the business. So every dollar that's made is subject to self-employment tax,
And how much is that?
15.3%.
So it makes sense. So if you make $100,000 and you don't have an S Corp, meaning you don't draw a salary, and you made $100,000, all 100,000 is your income. So you're going to be paying $15,300 on that 100,000 that you made for self-employment. If you
Right.
turn it into an S Corp and you made the same $100,000, but now 30,000 of that is salary, you're only paying the self-employment taxes on the 70, correct?
Yes.
Does
You're
that-
only paying, excuse me, you're not paying self-employment tax on the 70. You're paying nothing on the
Yeah.
70. You're only paying the social security taxes on the $30,000 of salary that you take as payroll tax.
And on the 70, you pay what? What is that called?
That's called a distribution, and it's not taxed for as self-employment tax. You pay nothing on it other than your federal and state income taxes.
Yeah.
So
So what would that be in, do you know Michigan's by any chance?
I don't know Michigan state tax, but it would be your federal income tax on 100,000 would be somewhere in the 22% tax bracket. So you're going to be paying 0, 10%, 12%, and 22%. So
Yeah.
actually,
Depending where you fall. So, but you can keep that distribution for the sake of the conversation.
you could take it. In fact, you don't have to do anything special. You can literally just take it. So here's our tax brackets. So the first, if you're married, the first 20,000 is taxed at 10%. Then it goes up to the next, I'm looking right up here. It's, so a portion of it's taxed at 12%, a portion of it's taxed at 22%. So that's federal income taxes.
Yep.
And then in addition to federal income taxes, you have to worry about self-employment taxes. I should actually show you guys this. You're never going to hear this in the press because they're always telling people that the poor don't pay any taxes, right? Here's all of our taxes that we collect in the country. 36%, 36.3% are employment taxes, social security taxes. Businesses, all of the huge companies in the country pay 7.5%. We pay more. We pay, what is that? 500% more in employment taxes, which are assessed only on wages. There is a phase out on a portion of it at 147,000. The working class pays this, period. Companies do not. So that 36% is what they never talk about. They do talk about income taxes. 53.6% come from income taxes. So this is business. This is income taxes. This is us paying income taxes. And this is Social Security. And if you listen, they always talk about how, oh, they're making people making less than $50,000 pay zero income taxes. You ever hear that? Oh, the bottom 50% pay zero taxes. That's a bunch of crap. I worked at McDonald's for $4.15 an hour. I had to pay Social Security taxes. I didn't have to pay income taxes because I didn't make any money, but it was the same things. Somebody asked a question about the what basically there's a whole bunch of questions coming here. I think they have the same thing. Generally speaking, it's dependent on your state's realty licensing board, whether we set you up as an LLC and taxed as an S Corp or a straight up corporation and then make the S election. It really depends on what your licensing is. 9 times out of 10, it's an LLC taxed as an S Corp because they're easy. You take a salary once a year, and I'll show you something really freaky here in a second. You take a salary once a year, and magically you don't have to pay this huge employment tax on about 70% of your income. So if you make 200 grand, we start doing the math. Let me see, I take a small salary. Let's say I take 50 grand as salary, and I'm going to have 150 grand coming out to me as a dividend or as a distribution. I'm not going to have to pay all these Social Security taxes on that money. It starts to add up pretty quick. And that's why people do it. Now, because the accountants don't do this. And by the way, there was a study by our wonderful government, and they did what they call ghosting, where they sent agents in with different scenarios to different tax preparers. And they wanted to see how many people got it right. And so they sent it to the chain preparers. They sent them out to the small tax preparers. You want to know what percentage got the business tax return correct? For chain preparers, 0%. They screwed up every single business return they did. Small tax preparers, they got 4% correct.
Wow.
They don't learn this in school. So you're doing something that your accountant probably never took a class on, or if they did, it was how some of those classes are, they were probably hungover. Who knows? But unless you do these things day in and day out and you work in real estate, you don't understand real estate.
I learned this from being surrounded by the people, right, that are where I'm heading. And then they were talking this lingo and I was like, what does that mean? Right. And then I would call my CP and I'm like, we need to do this. And he's like, yeah, that's a good idea. Right. But I felt like I was my own advocate of digging up all of this information and be like, we need to do this.
Gogo, that was the exact same route I went down, because when I met with my accountant that first time, I didn't know what an S Corp was. I was a lawyer. You don't take classes on this stuff, so you have no idea. In law school, you learn about corporate governance of publicly traded companies, and you're doing shareholder disputes and all that fun stuff. You don't learn basic, hey, how should I set up a small business? And by the way, LLCs weren't universally recognized in this country until 2003. The IRS didn't even know what to do with them. They were invented in 1977 in Wyoming. So they're still like little babies.
I mean, the whole madness, how it is started for me is I went on a girls trip with my best friend Holly to Paris. And on the way to Paris in the airplane, we talked all night, right? So she tells me about her LLCs and her companies and all that. And I was like, well, I don't have one. I just, I do everything under my license. And she goes, why not? Opening an LLC is $25. I was like, what did you say?
Mm-hmm.
Did you say it's $25 to open a company? Yes, it was $25 to open an LLC in the state of Michigan. Blew my mind because they don't teach us anything, right? To me, opening a company sounded so complicated. $25.
Yeah, well, okay. So I'm going to break it into 3 pieces here. Let me grab that. There's the state, and you could set it up pretty quick. You could go to LegalZoom and all these places, right?
Or any of your state website. All you need to do, go on the state website and then put in the name of the company you want. If it doesn't exist, you can create it.
That's the easy one. However,
I like to do
there's a right way and a wrong way to do it. There's manager managed, member managed. There's certain ways that you have to put, like, again, it depends on your realty board. Like out here, we have to put your name into the name of the company. Like you can't just go out and do it. You got to make sure you're doing it right. And that's because there's third parties. With third parties, we have to be very cognizant of something called an operating agreement. If you need to get loans or you open up a bank account or anything, you need that operating agreement. That's what never comes with these things, right? And it needs to be in your favor. There's a million different operating agreements. You want to make sure it's drafted so that you have 100% control. There's no subjective tests, that you get to decide everything. And then there's the feds, and the feds, for you guys, you could set up an LLC and you could choose to be a sole proprietor. If you have a partner, you could choose to be a partnership. You could choose to be an S Corp. You could choose to be a C Corp. Right? So for real estate agents, that's kind of your world. And I would say 99.9% of the time, you're going to choose to be an S Corp. With the state, you're going to choose to be an LLC. You want to have somebody verify that. We will do it for free, by the way. We'd be happy to chat with you. You can talk to our folks. There's about 450 of us here at Anderson. We do everything from bookkeeping, payroll. We could handle the whole lot for you, or you could do a lot of it yourself and just use us as guides. We have a bunch of programs to help out people generate more money. Like we try to be if you hire us, we want to do about a 7x return. Like I want to make sure that we are returning multiples of dollars back into your pocket. So here we go.
I took advantage of your unlimited LLC program, and I think you guys probably regretted coming out with that product, because in the last month, I think I opened 5.
I think I might regret you taking advantage of that.
So guys, after Mariana just posted the link, they have all kinds of services. So I signed up for pretty much everything that they offer, because I know where I'm going. Even if I don't have the need for it now, I know I'm going to have the need for it later. But one of the products that they offer is an unlimited LLC, where they literally create all of these LLCs for you, all your operational agreement. They mail you. I don't actually have a file up here now. I just got 3 yesterday. They mail you your file. So I just love it because I can open it and see everything, and all of my companies are in order. And I know I was prepared by some of the best attorneys in the country. So I sleep good at night.
We are real estate investors. So if you have real estate investor clients, you know how much of a pain it is to try to get financing, to try to figure out which entity it's in. If they're doing commercial, the commercial entity they always want a special use entity, and they want that owned by another Delaware entity. And and they're securing it with the interest in the entity. It gets really maddening quick. We do this stuff all the time because we've done it personally. We own a bunch of office buildings. So it's crazy. Yeah, we're in 45 different states, Lydia. And we provide registered agent services in all states, but we have employees in 45 states.
So can you explain what a registered agent is very quick? By the way,
Yeah. So when you have an entity, this little guy here, a lot of people just put their name as the registered agent. Like who gets served if that entity gets sued? So the state needs to know who is the agent for service of process. I would make it really easy. Oh, I didn't know Kelly Allison was on there. There she is.
Kelly, hey, Kelly.
Yeah, I didn't know that. Yeah, I'm so sorry. I didn't know you were on there. There you go, Kelly. Kelly's one of our advisors, and she works with realtors, so she's in there. So if you ask questions,
It's mine. Just kidding.
I
share.
I had no idea. I thought I was coming here solo, so I'm glad that she's there so she can do it. There we go. What I suggest is that you use a registered agent company like us. I think it's $125 a year, but it keeps your address out of the public record. And as an agent, I would suggest that you keep your address out of the public record. Like you don't want clients, especially, they'll show up on your doorstep eventually.
Yeah. The address is one thing, but eventually imagine if you are making it big, people might just sue you just because they know who you are, right? And if they can find all of the companies that you own because it's registered in your name, right? Those are the things.
They
so
do
with
it.
an agent, somebody else's name and address shows up, not yours.
I'm going to show you something because facts actually matter. Let me see if this works. There we go. This is the IRS Data Book, and they publish it every year because it's a government agency. They work for the Treasury. So this is their data. What I care about is how often a client will get audited and how often they will lose that audit. So when I set somebody up, I'm like let's say I was working with Christy or Gogo or anybody. Part of it is, hey, I could set you up in one of two ways, but let's see if there's a difference between how the IRS treats you. So this is the audit rates for different types of entities and different types of tax returns. So this is a business return without farm income, which is what you guys are. And let's say you're making $100,000 to $200,000 a year. You are in an audit rate of 1.6%. You are going to win your audit 5% of the time if you're field audited and 6% of the time if you do correspondence audit. That means sole proprietors lose 94 to 95%. Big frown, right? They get hammered. You know why they get hammered? Because the accountant says they're so much easier to run. You don't have to do all this record keeping. And there is no difference between an S Corp and a sole proprietor to the IRS. They do not care. You're held to the same standard. But these knuckleheads have been saying that for 30 years since I've been butting heads with them. They've been saying it for decades and they keep repeating it. So it must be true. No, you could just look at it versus an S Corp, which gets audited 0.2% of the time, and they win 31 and 28% of the time. So I'll just put it in English. Option one, you are 800% more likely to be audited than option two. You are going to lose 94 to 95% of the time on those audits. Option two is you'll be audited once every 500 years. And you're going to lose those audits 62 to 60 to 71% of the time. And it's actually something we have to think about. This is where guys like me who are actually fact-based, I look at it and go, what are you guys doing to your clients? All these accountants are like, hey, be a sole proprietor. The additional side is if you do option two, you're going to make more money. And the reason why is this, it's this whole thing. Hey, we know that we're not going to, like, I know why people get audited when they're an S Corp. I could tell you right now, all of those audits are because somebody didn't take a salary out of their S Corp. And the court and the IRS says you took a distribution, you didn't take a salary, you need to take a reasonable salary. And they reclassify about a third of it is salary and they're done.
So what's considered a reasonable salary?
Nobody knows.
Oh, so we
The
don't have
rule
like
of thumb, yeah, nobody knows what a reasonable person does because they don't exist.
I know, but it's like not a person. Like I'm not asking income, right? But is there a percentage that they say if you made $100,000, you should take a 40% salary? If you made $1
They
million,
use, yeah, the IRS and the tax courts have historically used a 1/3.
Okay, so your
When you
salary, if you made $100,000 and you're filing as an S Corp, you would have had to take a $30,000 salary, not to raise the red flag at the IRS.
Yeah, but the standard is actually what could I pay a third party to do your job? So what could I pay a realtor to come in and do your job?
Got it.
And the average realtor in this country makes $47,000 a year, but that's not the reasonable amount. The reasonable amount could be a range. So you're absolutely right. We use a third as a rule of thumb. And then if it's doctors or something specialized, then we might massage that. But there's reasons to actually have it be higher. And the reason that you do it higher is because we can actually contribute 100% of your salary into a retirement plan if you're making good money. There's something called a defined benefit plan that folks that are making over $200,000 a year, you do that for 2 or 3 years, we could pretty much write off almost 100% of your salary.
So I have a quick question on that. So when you switch over to do an S Corp, that would make up for not being able to contribute to a SEP. Would would that defined plan make up for what? Because
No, you can actually do both. You can't do a SEP and well, actually you can do a SEP and a 401k. There's two that you can't do together. You don't do it though, because a 401k, a solo 401k, I can contribute employee side and I can contribute 25% employer side. I get to contribute both. Me as the employee, I can defer $19,500 up to $26,000 into a Roth, by the way.
Okay.
If you want to put it into a Roth, it's crazy.
Oh, yeah.
I'll blow your minds for a second. You can contribute $58,000 a year into a Roth 401k, and it could buy real estate. If you like mining crypto, there's a way to set it up to where it could mine crypto. So how do you feel about self-directed IRAs? They are subject to tax on something called UDFI, unrelated debt financed income. And so when it works with real estate, it's almost always levered. So I don't like it for real estate. I would do a solo 401k, which is not subject to UDFI. Plus, you don't need a custodian. You could be your own trustee and control your 401k 100%. Somebody asked that question. Sorry. Go.
That's what I do. I control my own.
But watch this. This is what 99.9% of the accountants miss. And it's something so simple. It's called an accountable plan. Let's say, Gogo, do you have anybody that works with you on this call that's like an employee or
Yes.
that? Okay.
Quite
So
a few.
Chrissy. All right. So Chrissy, has Gogo ever said, hey, pick something up and I'll reimburse you?
Yeah.
All right. That's an accountable plan. So you pick something up, you bought pizza, donuts, or whatever.
Whatever he has, do not answer.
Okay.
Was it Krispy Kremes? I like the Krispy Kremes, right? So Christy brought it back, and Gogo, did you reimburse her out of the company?
Yes.
Okay. Where does Christy show that income? Does she have to report the reimbursement? The answer is no. This is why. Because amounts treated under an accountable plan are excluded from an employee's gross income. If you are a sole proprietor, you cannot be an employee of your own sole proprietorship. If you are an S Corp, you are an employee of your own S Corp. That means that S Corporation can reimburse you any reasonable expense you incur for the benefit of the business, including things like your phone.
How about a second car? Or a
So-
second house?
It can reimburse you the
Florida.
mileage on it.
I like your questions, Christy.
And Christy, believe it or not, it can reimburse you whatever portion of that home you use for the business. So if I have a home office and I'm a sole proprietor, I actually have, I'll show you guys these things side by side. I'm zipping through and I know I have it somewhere. I'll just find it in 2 seconds. All right, here's the difference. If I do these and I'm a sole proprietor, I get, if I have a 10 by 15 room, I would multiply that by $5 a year. That's what the IRS base amount for home office is. So I would get a $750 deduction if I was a sole proprietor. That same room, I would get a $5,109 deduction because I can reimburse myself. And this would be if you were an S Corp. It's not a small amount, guys. If you are a sole proprietor, I have to divide up what portion of my phone is personal versus what portion is business. If you're an employee, you do not. It can just reimburse you. If you have kids, by the way, and they're working for your business and they need a phone, guess what you get to write off? Their phone. What if they're using their computers? You can write off their computers. What if they're going to college? You could pay them at their tax rate instead of you paying their tuition. You could pay them and let them pay it at their tax rate, which let's say you're paying $10,000 a year for college or something like that. It's zero. Let's say you're paying $30,000 a year. Have them work for your business, do social media. I don't care. have them work for your business. And instead of you paying their tuition, let them pay for their tuition at their tax rate. It's going to save you a bunch. This is the actual math, by the way, on the home office. So I can actually reimburse whatever portion of the home that I am using under any reasonable methodology. I can use net square footage. I can use rooms. I could use anything. I get to write off whatever portion of my mortgage. I can reimburse whatever portion of the real estate taxes it ends up being, homeowners insurance, utilities. Even if I have a cleaner coming in and cleaning my house, whatever portion is being used for the business. So, you know, when I say portion, it means I have a room in my home that is being used for the benefit of this business. I can reimburse you. This is not something you report as taxable income. This is literally no different than Chrissy picking up a pizza and GoGo reimbursing it. It's just GoGo reimbursing herself for the use of her home. And GoGo, we haven't gotten to do this for your house. It doesn't matter whether you own it, rent it. The actual schedule, we get a portion of depreciation is put out by the IRS.
Can you do this for multiple homes?
For what?
Multiple homes?
You can do this for any home where you have an administrative office for that business.
Love it.
Yeah. And then this is funny. Once you have an administrative office in your house, anywhere you drive, if you're going to the office, now becomes deductible mileage. I think it's 58.5 cents a mile or 58 cents a mile right now. All of a sudden, anything you're doing between those offices becomes business. Otherwise, you can't write it off at all. This is why you set up a business. Once you set up that business and you start taking advantage of these, you'll be kind of shocked at, like, your income will start to drop because you're getting much more deductions. The business writes it off, but you don't have to recognize it as income. So it's kind of like the previous gentleman who was talking about mortgages, where they start doing stated income. It's because anybody that does taxes knows you can 2 + 2 could equal 5, right? Your accountant, a good accountant's gonna do that. So same token, if you're gonna qualify for a loan, you may not write some of this stuff off. You may let the income stick until you get your loan and then reimburse a bunch of stuff.
You
Not
see
wild.
why you need an awesome team by your side. You just need smart people. That's all. We don't need to. Here's how my history professor put it back in the day. You don't need to know everything. You need to know the person who does.
Yeah.
I don't need
Well-
to understand taxes. I just need to have Toby on speed dial. Right.
But-
I do like to understand things, but I'm not going to understand it ever on Toby's level. Right. But if I can have him and his team by my side, then I know then I sleep good at night, because here I am, then I can take my time and energy to go and build. When I have questions, I can call their team. They have different departments for everything. I mean, Kelly's on here. I do bother her, hopefully not too often, only when I have to. And Toby, I definitely don't bother you unless I have to. Right?
We do a ton of free stuff, GoGo. Like, your team doesn't have to come out of pocket. I just want to let you guys know, like, very sensitive to, especially people that are getting started, because I know what it felt like to, you know, I always joke, I'd go to Kentucky Fried Chicken to lick other people's fingers. I was so poor. You know, you're dumpster diving, right? It's like, I know what it feels like when you're starting something. We do every other week, we do something called Tax Tuesday, where we answer any tax question for absolutely free. We're very, very prolific on the YouTube. You could just type in Toby Mathis, but more importantly, you can meet with somebody like Kelly, probably Kelly, depending on how, you can meet with Kelly and it's not going to cost you a dime. I think they put a link where you can actually have somebody look at your scenario and say, here's about what it would save you. We can get pretty darn close looking at what it's going. So, like, you could say, oh, it's going to save me $5,000, but it's going to cost me $2 grand, like whatever it ends up being is like, maybe that's not worth it. Hey, it's going to save me $15,000 and it's going to cost me $1 million. Yeah, that's easier, right? I always say I want about a 7x return before it starts justifying my time. But that's what you're looking. I know somebody says something about cars. Here's the misnomer. If you were a realtor, I know you guys are using your cars a lot. There's always the question, should I have it company owned or individually owned? And here's the competing interest. I can reimburse the business use of that car if you own it, as long as it's an S Corp. Because you're an employee now, and it's no different than if GoGo wants to reimburse somebody for, here's mileage reimbursement. It doesn't matter what your car is worth. You do not have to report that. And it's as simple as putting an app on your phone called Mile IQ. It'll GPS track your business use and your personal use. And it'll say, hey, you just did a trip from here to here. Is that business or personal? And you say it's business. Is that something you're going to do all the time? Do you want me to remember those 2 points and always call it business? Yes. So if it's between your office and your home, for example, you'd track that as business. The company just reimburses you.
Yeah, it's like a dating site. If you ever use that, you swipe to the left for personal, you swipe to the right for business. Eventually, you just get the rhythm of it.
I don't know what app you're talking about.
Actually, I just heard about the dating site. I've been married for 19 years happily. I just heard about that part.
I'm just teasing you. No, my daughter's 24 and I was like, you better not be on Tinder. She goes, what's Tinder, Dad? I'm like, don't you do that to your father. I know exactly what you're doing. Right. No, but anything like it's really amazing when you start digging into these things, how easy it is. Now here's the beautiful part, because we work with a lot of different realtors and we have some really great ones. GoGo is a monster, but we have some heavy hitters out there that are strong 7-8 figure, right? None of them are operating as a sole proprietor. Zero, zilch. And almost every single one of them starts to layer. And when I say layer, is you go from, hey, I have an S Corp. Now I'm adding a 401k. Now I'm adding rental properties. Those are going to be in LLCs on their own. You start isolating things out. And then you say, hey, but I have more tax appetite. Yeah, there's a whole bunch. So somebody says, but Tom Ferry, Tom? Do you know Tom Ferry?
He followed me last 2 weeks ago. We were in Florida. I wake up in the morning and I'm like, Tom Ferry followed you. And it was still early in the morning. And I'm like, Tom Ferry. Tom Ferry followed me. I was like, goodness gracious. But no, I don't. I've never cold called. And what they teach is pretty much more along the side of cold calling and stuff. But I definitely know them and know of them. It's just I built my business differently. But they are monsters in the industry for sure.
Yeah. Tom's great. And I work with Tom. So I know. Super nice guy. It is organization, but they're not realtors. They just train sales and stuff on realtors, but they have a great niche and they do a great job. I'm just saying they have some monsters. You guys, EXP, I met one of your founders and your old CEO. He gave me the little tour, make myself an avatar, and all that fun stuff. I went for a boat ride with him. Right there, the fake boat ride, not an actual one.
In the world.
Yeah, in the world. But that was a few years back. That was fun. I love watching you guys. It's amazing how that technology works. And you guys are way ahead of the game, like in the metasphere. Like they're just starting to figure out that that's what's going to happen. So you guys are about 2 or 3 years ahead of everybody else. So enjoy it. But there's not a single person that we have that's in the higher end on that group that is not engaged in some sort of layering. In the last piece I want to give you guys, and I don't know whether we're running against time restraints, GoGo. I really want to touch on that legacy side. If you're working and you're doing all the hard work of showing houses or listing or whatever you might be doing in the real estate world, if you're an agent, you're working your ass off pretty much 24/7 all the time. I know it. Create something that is reflecting your values rather than just do the whole die and distribute. Hey, when I die, I'm going to leave it all to my kids. Please don't do that. Stats show that it doesn't make it. It's going to get wasted. 70% of families lose their wealth. No matter how much money you make, 70% have lost it by the second generation. There's actually an old adage that the first generation makes it, the second generation watches it, and the third generation blows it. So, I would say create something very easily. They're super inexpensive. It's called a trust. But you just put it in, just let something grow and use it for a specific purpose. So for example, if you think it's really important that somebody act as an entrepreneur, then you could say, here, you can use the money as startup capital. Here's the conditions. Or if you want them all to go to college or something like that, you say, here's an educational fund. Don't just give it to people. Put a little hook on it And then the
Yeah,
other
so
thing
for
is,
me, it's important, right, that I'm from Romania, Transylvania. I want my children to understand they are as much American as they are Hungarian. But I feel like it's my duty, right? And I take them home to Transylvania every single year. We spend 4 to 6 weeks. But what happens if I die? Right? So that's important to me. So if I will work it into hours. We are working on our trust. We just sent in the paperwork yesterday, where if they want to collect whatever, we are going to leave them yearly, monthly until they're 18 and until they're 20 something and yada, yada. And they have to do certain things, right? So you only get your money if and when you went to Romania for 4 weeks.
I'll tell you, so Gogo, you and I haven't talked about this, but I had a client who believed that you need to leave the United States to understand and have empathy towards people. And so their trust just pays for a trip for 7 days outside the United States once a year. That's all it does.
Not into an all exclusive Mexico 5-star resort.
Nope, it has to be approved by a trustee. So you have to run it by a trustee, and
Love
they
it.
actually want them to do mission work, but they don't want to force their religion on them. So they just said, leave the United States. Has to be a different country, has to be a different culture.
Love it.
So they're, and I'm like, I would like, if my grandparents had left that for me, I'd be like, where am I going this year? All it's going to do is pass on a value. And you could do that. Yes, we do trust. They're very inexpensive. I would say that they're a dynasty trust with every component, whether it be healthcare power of attorneys, end of life decision-making, burial instructions, financial power of attorneys, all of everything that works during your lifetime, all of that stuff, maybe a few $1,000s tops,
Let's talk about that too a little bit, because I didn't know that. Can you tell kind of the difference between a will and a trust?
Absolutely.
It's mind-blowing, guys.
Yeah. So a will is a fancy way of saying we're going to go to court when you die. And it requires probate. It's not an option. So we're going to go to court and we're going to be in front of a judge and we're going to decide who gets what based off of my writing, my will.
And they can also question if they think that you were in the right mind when you write that will, or that distant cousin that you haven't even know that they existed can come and fight your children on the part that they believe should be theirs.
Just look at Prince. Like if you want to, just Google Prince estate. It's still being probated. It's been 6 years. And all these people popped up out of the woodwork that were half brothers, half sisters, because under Minnesota law, they inherit. And so it's like people that Prince never knew are getting his estate and his music rights. It's a trip, right?
And if you trust, it pretty much what you say that happens. There's nobody involved. Like you're going to have an attorney, or you can have a best friend,
It's
or somebody
private.
you trust.
So one of the
read it
first
out
things.
loud, but whatever you said, it's what's going to happen.
One of the first thing a trust does is it keeps it private, doesn't get probated. So you don't have a court proceeding saying, here's what my assets are. Do you want to make a contest against it? The second thing it does is it disinherits anybody who contests it. So you want to fight it, you're out. So if you're a beneficiary and you think I'm going to screw over my siblings because and I've seen it, I've been there, done that, have that t-shirt, it boots you. The third thing about a trust is it works during your lifetime and beyond passing, and it can go on for hundreds of years. It doesn't require distribution. So I could put money in there. It says you get money if you need it. Health, education, maintenance, and support. It's called HEMS, and it's a standard that all trusts use that are for somebody that may or may not need assistance. So what it does is it says to your heirs, hey, if you ever get sick and you need funds, there's money here for you. If you want to go to school and you need funds, there's money for you. You need medical services, there's money for you. Otherwise, this money is going to be for the next generation. And what happens is it grows and it gets really, really huge. And it's like, if you give it enough time, I use an example that Warren Buffett said. He was coming after World War II, or during World War II, he invested. After the war, the market started to go up and he sold a bunch of stuff. He had $10,000 worth of assets that he had taken out. If he had just left it in there and all he did is invest it and hold it as an index fund against the Dow Jones, it would be worth over $41 million today, that $10,000. If you give something 50 years to grow, it goes crazy. If all you did was planted a seed, even if it was 10 grand and said, hey, this is here for something. And just let it ride. You'd be surprised after 20, 30 years, how much is there. A bunch of questions, by the way. The S is support. So it could support you. Like if, so it's health, education, maintenance, and support. So if you need some money so you're not homeless, it would provide you with a stipend to make sure that you're not homeless. If you need a car, like you're in school, your trustee will get you a Kia. It will not get you a Lamborghini, right? You have somebody who's actually being reasonable. And don't worry, there's trust departments of banks do this stuff all day long. Or you can designate somebody, or you could say it's going to be an attorney, an accountant, or a trusted somebody, but eventually you're going to be gone, and all the people that were around when you set it up are going to be gone over time. Let's say we're 100 years in the future. So we always put like, hey, it's going to be an organization, probably a fiduciary in a trust department. Is there a fee for the strategy session? No, we always give that out.
There's also a lot of training, as he said, so you can set up your appointment and have a conversation with Kelly. Kelly is my girl. I call her when I need her, when I have the stupidest questions, right? And she's very patient and explains it to me. But they also do a lot of free trainings that you can attend. You do not have to use their services, but it's worth it for, in my opinion, just have a conversation. They will meet you where you at, tell them where you at and where you're heading, and they'll tell you if their services would help you now, or maybe you just have to wait year or so, right? The other two things that were important to me is, as you're growing things, you need to hide them, right? Like you don't want people to be able to find all of the companies that you own. So can you talk about that a little bit, and then also talk about the LLCs being opened in different states?
Yeah, absolutely. So what Gogo is referencing is what we call is security through obscurity. If somebody can't find your assets, they don't try to take it away. And the example I would give you is if you got into a car accident and somebody was driving a really nice Mercedes versus the same person hit you and they were driving a 1977 Dodge Dart that had smoke coming out of it, and it had, 20 burger wrappers up on the and cigarette containers and beer cans rumpled around. You know what I'm talking about. The perception is, that person doesn't have money. The other perception is the other one does, especially if it says things like top MD on it or something like that, or top doc. We say, if you ever do that, you're just asking to be sued. Like, just don't do it. Right. So there are ways to keep your name out of a public record. We use land trusts for investment properties. You can use LLCs in states that don't track your personal information, like Wyoming and Nevada. And because LLCs are creatures of state law, you can set them up anywhere. And then if you're doing business, so for example, if I have rental real estate in Florida, I wouldn't even use an LLC. I would use a land trust because they have a statute that gives you the same protections. And I may take that beneficial interest in that trust, which if that just went over your head, it just means the right to occupy and the right to sell it. Go ahead.
That was Chinese. Yep.
Right. So it just means we can put it in an entity where all the benefits of that entity we take and we drop it someplace else. So it's like having a car. You could have the car, but we take the keys and we put it in a lockbox. So they can look at the car, but they can't drive the car because they don't have the keys.
Yeah. The way I heard somebody say it is like you're putting a box into a box. You're putting a box into,
that's a good way to put it. And for real estate investors, because we're avid investors, again, we are, I mentioned it earlier, but I have hundreds of properties. You don't necessarily at that point want to have hundreds of LLCs, right? I just want to make sure nobody can see what properties I have, because no offense, but there's people that will call you because you have a property. I don't know who those people might be. Sometimes it rhymes with realtor, right? And they're like, hey, you interested in selling? Like I get those calls all the time. Like if you want your name off of something where they don't know, you just put it in a trust and you make it an entity that's doesn't have anybody's name listed, and everybody goes crazy because they can't figure out who owns it. You might get a postcard or two off of that property.
And then when it gets complicated, so the reason I love the idea, right? I want the protection, I want to sleep good at night. But then where it gets complicated on our end, right, is then they started asking you questions. Oh, and this company, is this an S Corp or a C Corp or a partnership? Oh, how about this company? Do you have a holding company for this one? Did you open a bank account? How about, does this feed to the trust? That I'm like, whoa, everybody, hold on a minute, right? Because eventually, if the more companies you have, and there could be totally different companies from one another, or investments, or yada yada, you just won't be able to. At least I'm not able to know like which one is which, right? Member managed or manager managed, or I'm
We
like,
map it.
I don't, so they map it. So this is why I love their dashboard, is because you can log in, and I don't know if you maybe have a handy one, Toby, so you can show an example of that, but you can literally have a blueprint of everything that you own and what feeds into what and how is it structured. Like it's like a funnel, right? So you own these companies that go into this holding company or whatever that goes into your living trust. So you can kind of just see what's going on in your life.
Yeah, I'll see if I have. Kelly, do you have one floating around that doesn't have a client name on it?
Guys, sorry to interrupt you, but Gogo would have to wrap up in 5 because you have a 2:30 appointment.
Yeah,
So
so we have a few minutes. Thank you, Mariana.
What we'll do, Gogo, is we'll send you something you can send out so they see what a sample looks like, so that they could see. It's just boxes, and we like to color code everything so that we know if it's a holding
Yeah.
real estate, or is it a land trust, is it a corp? And don't worry, you would have a massive whopping 1 box, maybe 2 boxes. If you're complicated, maybe 3 boxes, and not a lot of compliance. It's the same stuff that you'd be doing anyway. It's just, it's going to lower the amount of taxes you ultimately pay. It's going to increase the amount of privacy you have. Creates a little legacy, which is kind of fun to think about, because everybody thinks about death and dying as being horrible. When you create something, it's the opposite. You start thinking of your kids and your kids' kids and your kids' 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 kids, and you start thinking, wow, they're going to remember, it's just, Celia, they're going to remember your name when you do that, as opposed to what our country, for whatever reason, loves to do, which is they love to dump money on somebody who's not prepared for it. But if you're going to work your butt off, don't make it for naught. Actually make it mean something.
Yeah.
And if you don't have kids, you don't want to have kids or whatever, leave it to an organization or create a foundation out of it when you pass away. You don't even have to do it while you're alive. You just say, hey, create a foundation and give it to, like, I like cats, give it to the cat funds, whatever. You just.
And that's the thing, that the part I didn't know and understood, and I'm so excited about it, that when you reach a certain amount, right, and you're going to have to pay hundreds and hundreds, if not millions of dollars in taxes, right, you actually get to start a nonprofit organization and take a portion of that, what you would have to pay to the IRS, and give it to a cause that you believe in. That's why all of the rich people have, finally dawned on me, that's why all of the rich people have these organizations and nonprofit organization or foundations, is because now I rather give $200,000 for research for a cure for type 1 diabetes than give it to the IRS.
You can actually run your own charity too, and you can control those funds and still invest it all you want into real estate if you care about it. And this is going to, I know you're up against the time, but this is going to warp your guys' minds. HUD, low income and moderate income housing, qualifies as a 501c3. If you never want to pay tax on something and you want to write off every dollar that gets invested into it, you can actually do it that way. HUD actually qualifies, recovery housing qualifies, veterans housing qualifies, single mom houses qualifies, anything that helps out low to moderate income. So HUD standard houses all qualify for 501c3 treatment. So I don't care whether you have $100 million in real estate. If you can avoid 100% of taxes if you want to. And it's always do I want to? And then, people always say, oh, how do I get to the money? You could pay yourself a salary, or realistically, if you're doing that, you're probably not taking money out of it. You're probably just putting money into it. Then let your kids run that later on. Like, hey, you guys can be on the board of my really badass charity that's doing all this cool stuff and has all these assets, and they'll get a salary for the rest of their lives, plus then their kids and their kids' kids and their kids' kids, kids. They'll remember Gogo. They'll be like, man, I'm sitting on Gogo. Remember Gogo? You remember great grandma about Gogo? And they'll be like,
I can't wait. I hope they do. I hope they remember me one day, right? I want to leave a legacy. I want to leave that little dot on the map of history. Then I was here and I did something.
Yep.
Thank you, Toby, for being here. Thank you so much for your team. You guys are awesome. I love working with you guys. We were texting back and forth with Christy a couple of days ago. She left me a voice note about I don't even know. She used some big words like syndication and holding companies and all of this stuff, right? So I messaged her back and I said, I cannot believe that these words coming out of your mouth. Like 8 years ago, when we started working together, we didn't have a clue what any of that thing was.
Nothing, like zero.
So how much we have grown in the past 8 years together, it's unbelievable. And I thank God for the people like you and, you know, your company that we actually get to learn from the best and everything that we work so hard for to make sure it's set up properly and we are protected and it's here way past hopefully our lifetime. So thank you, Toby. And Kelly, thank you so much for being here. I didn't know Kelly's coming on too today, so that's awesome. The link, it was provided, guys. If nothing else, join their free trainings. If you decide and when you're ready and you want to have a consultation, it is absolutely free. They can break your business down. You just kind of, they ask you the right questions, right? And based on that, they'll tell you what services they can provide and how much do they cost. But I can tell you this, that, how do I say this? What I paid versus what I'm going to save and make in the future, it's not a 7% return.
Oh, I say 7x.
I should say, yeah, it's not a 7x return.
We
it's
want 700%. We want.
It's a 7,000% return in my case, at least.
I just sent out your link, by the way, the link to everybody that you have that we put up for you. So we know that you're coming from GoGo. Because trust me, GoGo wants us, there's accountability. If we say we're talking to somebody, I need to be able to go back to her and say, you know, I want to make sure that there's no questions and things like that. Like she'll yell at us if one of you guys is saying, man, they just scrambled my brain, and or man, that Kelly, she's so mean. She could say, Toby, why is Kelly being mean to this person? And I could say, Kelly's not mean.
As Christy would say. What do you say, Christy?
Don't make me sick GoGo on you. We'll sick GoGo on them.
GoGo, you're a rock star. I'll get out of your hair.
Thank you, guys. Thank you, everyone. Thank you for being here. Go get them.
Bye, guys.
Bye.
Thank you.
Thank you.